Warm greeting to all of you. Today our group will be presenting on 7-Eleven Malaysia Holding Berhad. Our topic is financial statement analysis where we will analyze the company's financial performance and position. We choose this company because it is a well-known convenience store brand in Malaysia and we are interested to see how its performance financially in the retail industry. My name is Karina and my ID number is 252UG2537W. Now, let's begin our presentation.
Hi everyone, I'm Kartika Sivakumar and my student ID is 252UG2551A and I'll be presenting the introduction of our report. Analyzing financial statement is important because it helps us understand a company's profitability, stability and efficiency. It gives investors, creditors and managers a clear view of how a business has performed in the past, how stable it is now, and its future potential, which is especially important in Malaysia's fast changing market. For this project, we focused on 7-Eleven Malaysia Holdings Berhad, the largest convenience store chain in the country. Our analysis covers 2022 to 2024, with a special focus on 2023 when the company sold its caring pharmacy business to focus fully on convenience retailing. This allowed us to see how such a major restructuring decision affected its financial performance and overall direction. There are three main reasons why we choose this company. First, it is listed under the consumer product, services, and sector, which fits the assignment requirement. Second, as a market leader, its performance reflects wider consumer behavior and retail trends in Malaysia. Finally, because it's a publicly listed company, its financial data is transparent and reliable, making it ideal for ratio analysis and deeper evaluation. In short, this company was selected because it gives us both relevant data and a real life example how a strategic decisions like diversing a major business can impact financial performance over time.
Now, let's look at the industry overview. In Malaysia, 7-Eleven was established in 1984 and has grown into the largest convenience store chain with the more than 2000 plus outlets serving nearly 1 million customers daily. The stores offer over 2000 products, include exclusive items like Slurpee and provide services such as bill payment and touch and go reloads, making them a one-stop center for customers. 7-Eleven histories goes back to 1927 when J.C. Thompson founded the Southland Ice Company in Dallas. He came up with the idea of selling basic items like milk, bread, and eggs outside regular shop hours, which later developed into the 7-Eleven brand we know today. The convenience store industry in Malaysia is highly competitive with players such as Family Mart, My News, and KK Mart. However, 7-Eleven remains the market leaders by earning customers' trust, expanding its service, and receiving awards like the Putra Brand Awards. This shows its strong position and loyalty among Malaysia consumers. Let's move on to the financial ratio analysis of 7-Eleven Malaysia Holding Berhad for 3 years. Firstly, we will look at the liquidity ratios. This ratio shows the company ability to meet its short-term obligations. There are three main ratios which are current ratio, quick ratio and cash ratio. Starting with the current ratio, in 2024 it is 0.88 times, in 2023 it was 1.16 times and in 2022 it was 0.96 times. This shows that the company's ability to cover short-term liabilities has slightly decreased in 2024 compared to 2023. Next is the quick ratio, which excludes inventory from current asset. In 2024, it is 0.49 times. In 2023, it was 0.84 times. And in 2022, it was 0.55 times. The drop in 2024 indicates weaker liquidity when inventory is not considered. Lastly, the cash ratio, which only considers cash and cash equivalents, is 0.206 times in 2024, 0.71 times in 2023, and 0.27 times in 2022. This sharp fall in 2024 shows the company has less immediate cash available compared to the previous year. Overall, this result suggests that 7-Eleven short-term liquidity position has weakened in 2024, meaning it may face more challenges in covering its short-term obligation without relying on inventory or additional facing.
My name is Preeti Lakshmi and my ID number is 252UG 253DE. Here are the asset utilization ratio for 7-Eleven from the year of 2022 to 2024. The inventory turnover ratio for the year of 2024 is 4.82 times, 2023 is 5.384 times, and in 2022 is 5.983 times. In 2024, inventory turnover dropped to 4.82 times, continuing a steady decline since 2023, showing weaker stock movement. Next, receivable turnover for the year of 2024 is 12.62 times, 2023 is 22.28 times, and 2022 is 17.08 times. Receivable turnover also dropped sharply to 12.63 times, compared to the strong 22.28 times in 2023, meaning slower cash collection. Payable turnover for 2024 is 4.05 times, 2023 is 3.85 times, and 2022 is 4.055 times. Payable turnover was 4.05 times, slightly up from 3.85 times in 2023, showing quicker payment to suppliers. Total asset turnover for 2024 is 1.191 times, 2023 is 1.099 times, and 2022 is 1.406 times. Lastly, capital intensity ratio for 2024 is 0.84 times, 2023 is 0.91 times, and 2022 is 0.711 times. Similarly, the capital intensity ratio improved to 0.84 times from 0.91 times in 2023, but it remains higher than 0.711 times in 2022, suggesting efficiency has weakened compared to 2022.
Now I'll be explaining the debt or leverage ratios, which show how much a company relies on debt and its ability to manage financial obligations. The debt ratio stayed high at 86% in 2023 and 2024, but it's slightly lower than 91% in 2022. This means most of the company's assets are financed through debt, though there has been a small improvement since 2022. Next is debt to equity ratio. This ratio dropped sharply from 106.3% in 2022 to around 61% in 2024. This is a positive sign, showing the company has become less dependent on debt compared to equity, making it more financially stable. Times interest earned which is TIE, shows how easily the company can cover interest expenses with its earnings. It fell to 1.42 times in 2023, which was risky, but recovered to 2.16 times in 2024, showing improved stability. The equity multiplier decreased from 11.63 in 2022 to 7.17 in 2024, indicating lower financial leverage and less reliance on debt to financial assets. Finally, the debt to capital ratio improved steadily from 76% in 2022 to 62% in 2024, reflecting a healthier balance between debt and equity. Overall, the company's financial position improved by 2024. Although there were challenges in 2023, it managed to reduce debt levels and strengthen its capital structure, putting it in a more stable position for future growth. Thank you.
Now, let's look at the profitability measure of 7-Eleven Major Holding Berhad. Firstly, the profit margin in 2024 is 1.232% compared to 9.70% in 2023 and 2.24% in 2022. This shows that profitability dropped sharply in 2024 compared to the previous year. Next, the return on asset in 2024 is 1.57%. In 2023, it was 10.67%, and in 2022, it was 3.15%. Again, we can see a big decline in 2024, meaning the company is generating a less profit from its asset. Lastly, the return on equity in 2024 is 11.25%, while in 2023 it was very high at 75.6%, and in 2022 it was 36.63%. This also show a large drop in 2024, indicating a weaker return for shareholders. Overall, the profitability ratio suggests that while 7-Eleven performed strongly in 2023, its profitability fell significantly in 2024 compared to the past 2 years.
Hi, I'm Kumudavali Kunalan, and my student ID is 252UG252G. Now, let's move on to the market value ratios, which give us insight into how the company is being valued in the market and how attractive it is to the investors. Looking at the earnings per share, we can see it dropped significantly in 2024 to just 3.47% compared to 24.34% in 2023. This decline indicates weaker profitability per share. The price to earnings ratio shows an opposite trend. In 2024, it jumped sharply to 52.16 compared to only 7.08 in 2023. A higher PE ratio suggests that investors are paying much more for each unit of earnings, which could mean the stock is seen as overvalued or that investors expect strong future growth. Next, the market to book ratio has been relatively stable, moving from 12.30 in 2022 down to 5.292 in 2023 and slightly up to 5.82 in 2024. This indicates the company is still trading above its book value, showing positive investor confidence. The price to sales ratio decreased from 0.915 in 2023 to 0.686 in 2024, which suggests investors are valuing the company lower relative to its revenue. For book value per share, there's a slight dip from 0.322 in 2023 to 0.309 in 2024, reflecting a marginal reduction in shareholders' equity on a per share basis. Finally, the EBITDA ratio, which was 8.94 in 2022, declined to 3.38 3.85 in 2023. And for 2024, it's not reported in this table. The decreasing EBITDA ratio signals reduced operating profitability. Overall, these ratios shows that while market expectation for the company remain high, especially with the spike in the PE ratio, the underlying fundamentals such as EPS and EBITDA suggest challenges in profitability.
Moving on to interpretation of financial analysis. Looking at 7-Eleven's performance, its operations are strong, supported by fast inventory turnover, quick receivable, a trusted brand, and its wide 24/7 outlet network. However, profitability has been unstable, rising sharply in 2023 before falling in 2024, creating earning uncertainty. Liquidity is also weak with limited cash to cover short-term needs, while leverage remains high with liability making up more than 85% of assets, exposing the company to financial risk. In short, 7-Eleven runs efficiently and attracts steady customer flow, but unstable profit, tight liquidity, and a heavy debt leave it financially vulnerable. To secure long-term growth, it must build stronger cash reserve, reduce debt, and maintain more stable earning. Let's look at the strength of 7-Eleven. Firstly, efficient inventory management. Inventory turnover remained healthy at 5.98 in 2022, 5.38 in 2023, and 4.82 in 2024. Although slightly declining, these levels are considered strong for a convenience store, minimizing storage and spoilage risk. Secondly, profitability potential. Return on asset (ROA) peaked at 10.67% in 2023, showing the company's ability to generate strong returns when operations are managed efficiently. Thirdly, strong receivable management. Receivable turnover was 17.08 in 2022, 22.28 in 2023, and 12.63 in 2024. Despite the 2024 decline, these ratios highlight fast collection and reliance on cash transaction, which support working capital needs. Fourthly, brand strength and market presence. 7-Eleven benefit from its wide store network, round-the-clock operation, and high brand recognition, ensuring steady customer flow. On another point, the weakness of 7-Eleven are high leverage. The debt ratio has stayed between 86% and 91% over 3 years, indicating excessive dependence on borrowings. This limits financial flexibility and heightens risk during downturns. Next, profitability volatility. ROA fell sharply from 10.67% in 2023 to 1.57% in 2024, reflecting inconsistent profit generation. This unpredictability undermines investors' confidence and signals the need for more sustainable earning management. Competitive pressure. Intense competition from Family Mart, KK Supermart, and 99 Speed Mart forces 7-Eleven to engage in aggressive promotion and price competition, which squeeze profit margin. Lastly, liquidity risk. The cash ratio rose to 0.71 in 2023 but dropped to 0.21 in 2024, indicating insufficient immediate cash to cover short-term liabilities. This raised the risk of liquidity shortfall if cash inflow weakens.
Hi, I'm Hamsavahini Murugu Subramaniam and my student ID is 252UG2545V. Let's move into 7.0 investment analysis and recommendations. Investment evaluation. Strong operations. The company shows strong operations with a wide store presence, a trusted brand, and efficient management of inventory and receivables. Profitability volatile. Profitability has been volatile. Return on equity peaked at 75.6% in 2023, but dropped sharply to 11.25 in 2024. Weak liquidity. Liquidity is weak with a current ratio of 0.88 and a quick ratio of 0.49 in 2024, suggesting limited short-term resources. High leverage. The balance sheet carries high leverage with a debt ratio of 86% and a debt to equity level above 600%. Valuation risk. There's also valuation risk as the price to earnings ratio is above 50 in 2024, despite subdued earnings. Overall, overall operations are reliable, but the high financial risk suggests a cautious outlook. Let's move into recommendation. For current investors should hold their shares but monitor debt reduction and profit stability closely. Liquidity. The company should build stronger cash reserves and improve working capital efficiency to strengthen liquidity. Next, leverage. It should reduce reliance on short-term borrowings and refinance some obligations into longer-term debt. Profitability. Profitability could improve by tightening costs and focusing on higher margin products and services, including ready meals delivery and digital solutions. Expansion. Store expansion should be paced carefully in line with cash flow rather than fueled by additional debt. Next, transparency. Transparency could improve through clearer reporting on one-off items and adapting to dividend policy linked to free cash flow. For new investors should enter the stock gradually but only once leverage declines and profits become more stable. Let's move into 8.0 conclusion. Strengths: strong brand, 24/7 outlets, efficient inventory and receivable turnover. Weaknesses: weak liquidity, high leverage, volatile earnings. Focus areas: strengthen cash reserves, reduce debt, enforce cost and margin discipline. And the next one is growth strategy: gradual innovation in products and services without overextending resources. Investor view: long term potential for patient investors, less attractive for short term gains. Key insight: balanced financial review is essential for informed decisions that safeguard performance and create value. That's all from me. Thank you.